Hi again. At this point, you've completed all of the steps. You've done the journal entries. Everything's great. Let's just take a look at what happens to the income statement. So we're looking at the partial income statement just from the line that says income from continuing operations before tax. That's that $850,000 that we started with. We'd already completed this part when we discussed the allocation of the current tax between continuing and discontinued operations. So looking at the journal entry here, we're just going to fill in the rest of the numbers. So the current income tax expense is the $198,735. And the deferred tax expense is $58,590. This is then how the income statement for December 31st, 2017 looks. And of course, we would use the same process for the financial statements for December 31st, 2018. And just one more thing. Remember, originally we calculated the taxable income. We did that by starting with the income before tax. We adjusted it for the discontinued operations. And then we looked at permanent differences. These are the amounts that are never going to attract tax or be deductible from tax, and so they get left out of what I'm going to show you. And we're going to start then with this $876,550. If there were no timing differences, the tax then that would be payable on accounting income is the $876,550 at 30% would be $262,965. But there were timing differences. And so our taxable income, $681 at 30%, our taxes payable were $204,375. The difference between these two numbers is the deferred tax expense. It's the amount that reconciles the total tax payable to the tax that would be payable after you've accounted for permanent differences on accounting income. So to start it there. And just remind you, we can take a look here at the schedule for the deferred tax liability, and in here you can see that $58,590 that we're seeing here. Now, isn't that just so cool? Eh? Isn't it? All right, maybe it's just me. I think it's great. Thanks very much for listening.